Dear learner, welcome again. We were discussing the part 12, and in the part 12 we are discussing the strategic approach to the management. In the part 12, so far we have covered up the module 56, 57, 58 and 59, and this particular module we are discussing the financial function of the management in the module 60. Before we start this module, let us try to understand the things we have studied so far in the part 12 and from module 56 to module 59. We have started this part, and the objective of this part is to make you learn about how the strategic approach are implemented in the management. And we started with the strategic growth by understanding the two dimensions of the strategies. One is your internal and another is your external strategic growth. Within the internal, we have discussed about the internal growth strategy, or we call it as an intensive growth strategy. Second, we discussed about the diversification strategy and modernization approach. On the other hand, the external strategies, we emphasized on understanding the merger, joint ventures and integration. Within integration, we have seen about the backward integration process and forward integration process. Further, we have tried to uncover the concept about the marketing. We discussed that how the marketing can also be a factor for the strategic growth. If the companies or the manager is not taking the appropriate decisions or not framing the appropriate marketing strategy, all their resources will not be so impactful. Okay, so we have discussed about what marketing is. We have emphasized on the marketing mix as well, marketing mix, that we called it as a 4P concept. And we try to understand each of the element of the marketing mix. And lastly, we discussed about how these marketing as a functions can be implied in framing the organizational or the departmental strategies and the objective. Within this, we are continuing in the model 60 about the finance functions of the management. Every department has its own significance and they contribute towards attainment of the organizational objectives. We have learned in this overall course so far the principles of the management, that it is the coordinated effort, the integrated effort of all the levels of the management, all the departmental heads, the supervisory level of the employees, the coordinated effort of all the staffs within the organization is most important aspect in attaining the organizational objective. So we cannot overlook the finance functions as well. Finance, we know that it is considered as the blood or the lifeline of a company. No matter how advanced the technology that you are using, no matter how effective your promotional program are, how you are differentiating your products from the competitors, if you are not able to manage the finances, then all these things will not be sustainable for a longer period of time. As you students will be the future manager, it is very important, it is very paramount that you should understand the basics of the financial management, because all these things will be helpful in understanding or taking the key decisions in different projects. When you will be like taking the decision as a manager, the different situation will be available to you. You have to pick up the best situation or the best project out of many. Then what is the basis for the selection of the project? The financial management as a function will help you in choosing the best suitable project that has the higher return on investment. As we know, the capital which we use, the company which generate from the different sources, which we'll be discussing in the later part of this module, it is very limited. It has some certain cost. All right. So it is paramount important that one should be judiciously using all the funds or all the resources that the organization is having. So with this, we start this module, and the overview of this module that will be understanding the financial function of the management, the sources of the capital in the management, that is from where the capital of the organization will be generated, the type of the capital, the fixed and the working capital, and lastly, very important concept about the break-even analysis. So very first thing which is important is the definition of the financial management and the concept of the financial management. Financial management emphasizes on how effectively you are using the organizational resources in order to achieve the objective. Managing the finances within the organization is very difficult task, because the nature of the finances or the nature of the cost is that they tend to increase. We'll be discussing about the types of the cost and how these things can be managed. But before that, let us discuss the standard definition of financial management. According to the, as you can see in this slide, according to the Gutman and Dougal, financial management is the activity concerned with planning, raising, controlling, and administrating funds used in the businesses. So capitals or the funds are generated within the organization, and it requires proper planning. How the fund will be raised, what are the different controlling techniques which can be used to have the proper allocation of the fund and proper utilization of the fund, as well as making sure that these funds are attaining the organizational objectives. Okay, so financial management is using the financial resources efficiently. There are different cycles, or we can say the different process of the financial management. The very first one is the planning for the fund requirement. As you can see, the different steps which are required. The very first one is like you will be taking the decision on how much funds which is required. It depends on the projects. Suppose the project that you have undertaken is a very big project. Too much of capital will be invested, capital expenditure will be invested, too much of machinery will be purchased. All right, you require to set up some kind of technical workshop as well. You need to hire some skilled workforce. So it require huge amount of capital. Okay, and based on that, the funds requirement process will be initiated. Let us take one example. Suppose take one example of the company Ola. Ola, we all know, is a company. Okay, it provides the cab services. Suppose Ola want to initiate a new project. in an area they want to introduce the new cab services which earlier was not available. Okay, like the area, this area is Rampur. This is in a hypothetical example we are taking. So Ola want to introduce the cab services in Rampur. All right, this is the new project that they want to start. Now, in order to start this project, the company will be planning the fund requirements. Okay, fund requirement in terms of like they will be deciding 3 routes: route 1, route 2 and route 3. Now 3 routes are like they will be going for, and they have to select one route. This is the assumption, because of lack of fund, scarcity of the resources, you cannot optimize on all the projects. You have to select the best project whose ROI, return on investment, is higher. So for each of the routes, the Ola will be like planning for the fund requirement. Like for example, the very first route is costing rupees 2 crores, next is 2.2 crores, and next third route is 2.1 crores. All right, so it will be based on the planning stage. Now the capital structure means like how you will be generating the capital and what could be the total structure. Okay, it could be with respect to the debt and equity. How much you want that the fund out of the total, suppose the route 1 which is selected, out of the route 1 you need to have a total of fund of 2 crores. Now out of the 2 crores, how much you want from the debenture holders or from the creditors, and how much you want to sell your own equity or the ownership. Okay, that is through the issue of the shares or the preference shares. Now the management has to take the decision. So financial management is all about taking the decisions. Now again you will see the fund requirement. You have to select which route is more beneficial. It will be dependent on the ROI. Second, the capital structure. You need to take the decision that whether we should be increasing the debt of the company or whether we should be going for the equity. Like it is better that you can go for the equity because you don't want to increase the debt because it has higher interest you have to pay. The cost of capital that we call it. The cost of capital for the debenture is higher as compared to the equity. Why? Because at any point of time, even the company is making the losses, you have to pay the interest to the debenture holders. But the equity shareholders will be given the dividend only when the company is running at profit. But again, a dilemma will come that if you will be going for the equity, you will be losing out your decision making power. All right. And if you will be going for the debt, you will be end up paying the higher cost of capital. So the optimum cost of capital the company need to decide for. Again, the third one will be, this is the second one, this is the third one, investment of the fund. Where the fund will be invested, whether you will going for the capital budgeting, okay, or you will be going for the regular thing, not on the investing more on the capital thing. Capital things means the investment whose return you will be seeking after long period of time. Okay, suppose you have purchased a machinery, land and building. So how much the company has to decide how much money you need to invest in the capital things, okay, and the recurring expenses. Sharing of the surplus, again the decision has to be taken with respect to how much amount of dividend you should be distributing with the shareholders. If the company is making a profit of 10 lakhs, out of the 10 lakhs, the dividend or the shareholders will be claiming some return. They will be asking for the return. Then you have to pay certain dividend to the different shareholders. But at the same time, you have to take the decision that we need to retain the profit as well. All right. So retained earning is also one of the important element as a source of fund. So again, the manager has to take the decision. And further, the cash management. Okay, this is the fourth one, this is the fifth one. Cash management and evaluation of the total strategies that you have undertaken. Whether the strategies that you have taken is impactful or you need some kind of revision. Basically, you have to go for the controlling technique that we have studied. Okay. So this is all about the concept about the financial management. Going further, let us try to discuss about the second aspect, the sources of the capital. How the capital will be generated? This is the biggest question or the biggest task for the manager. As you can see in this slide, the source of capital could be of capital market and the money market. Or we can say the long-term capital finances or short-term capital finances. Very first one is the capital market. Capital market, you will see the revenue can be generated through issue of equity and preference shares, debentures, financial institutions, retained earning and public deposits. Majority part we have already discussed. The equity shares means those who have some kind of ownership or equity in your organization. All right, like you were the promoter of the company, you invested all your money, now you have sold your ownership towards the different equity shareholders. Now they are the owner. Okay, now they have the right to take the decisions or they have the voting rights. Preferential shareholders has preference above the equity shareholders in terms of getting the dividends or in terms of winding up the company. The very first will be given towards the debenture holder, then the preference shareholder, and if any amount are left, then the equity shareholder will be redemption will be done as per the rules. Financial institution, like there are different institutions like the state financial corporations, okay, other financial corporations. So they will be also providing or assisting the companies in providing the loan at the lower rate. Retained earning, we have discussed, like the company is getting the profit. Now the company is retaining the profit for some growth purposes or for some kind of uncertainty in the organization. Those part of the profit is termed as the retained earning. So it is also a source of the fund. Public deposit, in many sector or many industries, public also contribute towards the source of the fund for the organization. Second is the money market, the short-term market or the short-term securities market. Very first one is the trade credits. Okay, trade credits means it is more applicable into the B2B industry, where the one company is taking some kind of inventory or the raw material from the another company on the promise that they will be paying after a certain period of time. It could be like 30 days, 60 days, 90 days, 120 days, but it should be less than 365 days or less than 1 year, because it is of short-term nature. All right, and in return they have to pay certain incentive or some kind of interest, which is very nominal. Banks, the commercial banks also provide the short-term loans to the companies for specific purposes, that they need to pay the amount of liabilities to the creditors. They need to like purchase some kind of raw materials, operational purposes. So banks also, the commercial bank also provided provision and reserves. Okay, like for specific purposes, the company may create some provisional account, okay, or some kind of reserve account. So it also act as a source of fund for the short term, meeting the short term liabilities of the company. And the financial institutions can be granting the company for the short term liabilities as well. So with this, we have discussed about the sources of the capital as well. Now other aspect is with respect to we are discussing about the classification of the capital needs. Okay, we have seen that the overall capital of the company can be divided into the fixed capital as well as the working capital. Now the fixed type of capital is used for some purchase of fixed capital expenditures. Okay, like you are starting a new project. Coming back to our first example, where the Ola wanted to start a new project in a Rampur village. Okay, now what are the things that they will be requiring? They need to have a proper like purchase of some cars, at least 10 cars where the cab services can be initiated. They need to hire some employees, maybe on the contractual basis, but its cost will be higher. Again, they need to have some kind of software update program. Okay, so these costs will be a capital nature. Okay, because you won't be purchasing your car on a regular basis. These are the capital assets. So fixed cost is a type of the cost which are incurred, or which not fixed cost, fixed capital. Fixed capital is a type of capital which is required for the purchase of certain fixed assets, whereas the working capital, which require to make the payment for a regular liabilities or any kind of purchase of raw material, any kind of make payment to the wages or meeting or the short term liabilities, all right, paying bills, insurance payment. So all these will be under the working capital. So working capital could be like less than 1 year. All right, any expenses that you are paying which are having the nature of less than 1 year, it will be done through the working capital. As you can see, it is the working capital cycle. Now the cash will be generated. Now the cash could be generated from any other sources, like from the banks or the financial institutions, okay, from trade credit. It will be leading towards the operating expenses. Operating expenses means the expenses which are incurred in the operation of the activities. Okay, like converting the inputs to the output, that is converting the raw material into the finished or the semi-finished products, is your operating expenses. All right. Again, operating expenses means you're purchasing certain kind of raw material, you are employing some labor. All right. So all these will be under the category of the operating expenses. Next process is the production process. Production process will be comprised of the cost which are incurred in converting the raw material into the production. It will be under the factory cost as well. It can be considered as the factory cost as well. Right. The factory cost means like any kind of repair of the machinery, small equipments that you are purchasing, okay, or with respect to the payment towards the supervisor, or any technical staff, any expert. These will be under the production process. it will be leading towards when you will be purchasing the raw material, you will be converting the raw material into the product, then you will be keeping the raw material. That is your inventory. All right. So inventory cost, certain cost is also there with respect to keeping the inventory. Suppose you are purchasing any kind of perishable product. You need to keep it into the warehouse, certain temperature, or the product will be damaged. Again, the sales, the inventory you are you are manufacturing for whom? For the consumers, for the different companies. Then the sales will be generated. The sales will be generating some kind of receivables, and again the cash will be you will be able to get the cash, and you will making the payment, and you will be having the profit. So that's how the overall cycle of the working capital goes on. All right. Next is factor considered in deciding the working capital, like how much amount of working capital you will be requiring. Ultimately, it has certain factors. Very first one is the nature of the operation. Suppose the nature of the operation that you are performing is very repetitive. On a regular basis, you are purchasing the raw material, not purchasing, but converting the raw material into the finished or the semi-finished product. Then the amount of working capital will be higher. Okay, volume. The more and more product you will be manufacturing, the more and more working capital you will be requiring. Production length. If the length of the production, it means you are taking too many time to convert the raw material into the finished products, the more and more cost will be incurred. Okay, so in that case, higher the length, larger the requirement for the working capital. Annual turnover. Okay, credit grant, it means on what basis you are selling the product, what are the different terms and conditions. If you are selling the product, majority of the products which are sold are on credit, then you are not receiving anything. Then in that situation, the requirement for the working capital will be larger. Last one is the seasonal factor. In some situation, it could be you are manufacturing more, producing more. In that situation, the working capital requirement will be larger. Like during the summer season, you will see the demand for the repair for the AC, all right, is higher. Then these electronic company need to keep the different parts of the AC higher or larger as compared to the off season. Okay, so these are some of the factors. And lastly, let us try to understand about the break-even analysis. Break-even analysis is a technique which attempt to measure the point where the profit or the losses equates. Okay, it is a point where the total fixed cost or the total cost, it is total cost equal to total revenue. All right. So let's we understand with a graph. Quickly we try to understand this concept. Suppose this is your y-axis and this is your x-axis. As we know, the total fixed cost. What is the nature of total fixed cost? That it remained constant over a period of time. No matter how much unit you are manufacturing, your total fixed cost will remain constant. So as you can see, this is the point 0, this is the unit you are manufacturing, and this is the total cost or the total revenue and cost. The more and more unit you are manufacturing, suppose it is 10,000, 20,000, 30,000 and 40,000. You will see even at the 0 level, the fixed cost is same. Even at 40,000, the fixed cost is same. This is the nature of the fixed cost. Now the total revenue will start with the 0. We call it as a total revenue, TR. At 0 level of output, you do not generate any revenue. But at 0 level of output, you have certain fixed cost. Suppose this is the total cost. Now this portion is your total fixed cost. This total portion is your total variable cost. Now the cost we classify into different categories. One of the classification is the total cost is the summation of total fixed cost as well as the total variable cost. Variable cost will fluctuate as per the unit you will be manufacturing. Right. Even at zero level of output, you do not have any kind of variable cost. But as you increases the number of output, the variable cost will proportionately change. So the summation of total fixed cost plus total variable cost is equal to total cost, and this is the total revenue. This area will be the profit and this area will be the loss. Why it is so? As you can see, the total revenue line is above the total cost line. That's why this area where you are generating higher revenue and the total cost is lower. But at this area, you will see the total cost line, this line is above the total revenue line. That's why your cost is higher as compared to the total revenue, and this area is a loss area. So for the manager, it is very important, and this point where these points intersect, the most important point, we call it as a break-even point. So break-even point can be helpful for manager in taking the key decision in understanding how much unit that they should be selling, the minimum unit. Suppose it is 20 to 30, it is 25. Okay. So how much unit that they should be selling, the company should be selling to cover up the total cost of the organization. When they are selling 25,000 unit, as you can see in this graph, the total cost is covered. And beyond 25,000 unit, they will be having the profit, as you can see in this graph. So with this, we have thoroughly understood about the last part, that is part 12, and that too the last module, the module 60, and we discussed about the financial function of the management. And this ends the course, and I am hopeful that you students have got the conceptual knowledge about the principles of the management, and we'll be discussing anything that you have not understood. Through the comments I will be getting the different kind of queries you will be having, and we'll be conducting a live session where you can raise your queries together, and I will try to sum up all the answers. That's all for this session, and it was very nice meeting you all. Thank you and happy learning.